Good afternoon, everybody. It is now Monday, April the 4th, and if you're watching the financial news, if you're kind of a wonk and a geek on this stuff, as I am, we had something that happened on Friday that sort of simmered around and made some headlines. That was a yield curve inversion. So what is a yield curve inversion? I'm going to read this directly off Investopedia, and then we're going to talk a little bit more about it. So yield curve inversion is basically this. The yield curve inverts when long-term interest rates drop below short-term rates, because investors expect short-term rates to decline in the future, typically as a result of impaired economic performance. Such an inversion has served as a relatively reliable recession indicator in the modern era. So what it basically means is this: in a normally functioning bond market, you should basically, as an investor, you should be demanding a greater yield, a greater return by going further out in maturity in the fixed income markets. So as just a basic example, if I want to buy a 2-year treasury, for example, and let's say I'm getting 2% on that, if I'm going to go out to 10 years, I need to be compensated for that additional risk of going out further. So maybe it should be yielding 2.75 or 3%. But what we had on Friday is we basically had the yield in the 10-year fell to 2.331%, and the yield on the 2-year was at 2.337. So he has 2-year rates up here, 10-year rates down here. The reason that's a big deal is because, as I mentioned before, it has been a precursor to recessions in the past. Looking over my other screen here in terms of this data, it doesn't mean there's a recession that happens tomorrow, but it's been a pretty reliable indicator. So let's go back into the 1970s, August of 1978. Yield curve inverts. 16 months later, we get a recession. September of 1980, yield curve inverts. 10 months later, we get a recession. 1988, same thing. 18 months later, we get a recession. June of 1998, this is really deep into the dot-com boom in the S&P, year over year, 20% returns. 33 months, it's almost 3 years later, we obviously get the dot-com bust out. We get 9/11 that happens after that. January of 06, we all remember the Great Recession. 22 months later is when we finally were in recession after the yield curve inversion. And August of 2019, obviously COVID came not that long after. We did get a really short, brief, and very sharp recession for sure with the COVID pandemic. So what does it mean? It's just added to things of what we need to be watching. One thing that's really different about this inversion than the last two that we've had, saying going back to 2006 or into 2019, in both of those cases, the Fed was really aggressively raising short-term rates. They've just started to do that now, but now we're just into the beginning of this rate increase cycle. The Fed rate basically is at 25 basis points, 0.25%. These other inversions occurred when basically the short-term rate, today's rate, was pretty equal to the 2-year rate, and the 10-year rate was a little bit lower. We've got a curve now that isn't like inverted where it's just heading down. The longer maturity that you go, the more rates go down. What we see is almost still 0% rates now. Pops up at 2 years pretty dramatically, then levels off at 10 years, and then kind of goes up again at 30 years. And usually you need to see these inversions persist for not just a day, not a blip on the trading screen like we had on Friday and into today. You really need to have this persist for about a month or so before you can begin to take it seriously. But it's definitely one of these things that's worth watching. And I do think, looking at all the economic data that's out there, increase in energy prices, inflation for sure here, supply chain disruptions, new lockdowns in China, disruptions that we have because of the war in Ukraine, to think that we could be in recession in the next year or two for sure is not a stretch. So yield curve, it's another thing for sure to be watching and that we're looking at. Usually what you see is the immediate performance of the stock markets after a yield curve inversion. Again, looking back at history, yield curve inverts, that's basically the market saying probably going to get a recession. You never really know what it's going to be, whether it's going to be housing crisis like 06, dot-com bust at /9/11 like we had in 2001, energy crisis in 78, Paul Volcker in 1980 dramatically raising interest rates. Like there's always some kind of catalyst that throws the economy, at least in the near term, into a tailspin. The yield curve inversion tends to happen before some of these things. Equity prices, though, don't really follow it. In fact, if you look again at going back through historical data, usually equity markets continue to perform pretty well with somewhat of a bias toward large cap stocks if we get that yield curve inversion. So I wanted to address it. It's one of these things I'm watching. A day and a half of trading for sure does not make a trend, but it just bears worth watching. It's another thing to put on the radar. But I'm pretty sure that some people are gonna be at home saying, hey, wait a second, I saw this news story that talked about the yield curve inversion. What does it mean? And again, it simply means this, that short-term rates slightly higher than long-term rates, which in the past has shown that we might have a recession that we have to deal with in the future. But what's important to note here, though, is I'm going to complicate it before I get done with this video. Some people say the yield curve inverts if the 2 year's higher than the 10-year. Other people say, no, it's not an inversion unless the 3-month is higher than the 10-year. Or 3-month is still pretty darn close to zero. So we're nowhere near inverted. We got a massive gap between 3-month interest rates and 10-year rates. So was it really an inversion? By one measure it was, by 2 years to 10 it was, by 3 months to 10 years, not even close. So just wanted to get this video out there today in case we get any questions on it. It's kind of one of these more sort of wonkier bond market / interest rate discussions that if you want to talk about this in greater detail, be happy to get into it. Please give me a call myself, a member of my team. Let's schedule some time to talk about this stuff. Again, if you see it on the news, you want to know more about it, give me a call and let's go over it. Anyway, I hope everyone has a great week and I'll talk to you soon.